Chapter 10, Part 1, Accounting Principles, Conventions and Assumptions. Contents: Accounting Principles, Business Entity Concept, Consistency, Duality, Going Concern, Historical Concept, Matching Principle, Materiality Concept, Money Measurement, Prudence, Realization, International Accounting Standards, Comparability, Relevance, Reliability, Understandability, Capital Expenditure, Revenue Expenditure, Capital Receipt, Revenue Receipt, Inventory, Valuation. Accounting Principles. Accounting principles are sometimes referred to as concepts and conventions. The concept is a rule which sets down how the financial activities of a business are recorded. A convention is an acceptable method by which the rule is applied to a given situation. Business entity. The business entity principle is also known as the accounting entity principle. This means that the business is treated as being completely separate from the owner of the business. The personal assets of the owner, the personal spending of the owner, etc., do not appear in the accounting records of the business. The accounting records relate only to the business and records the assets of the business, the liabilities of the business, the money spent by the business, and so on. Everything is recorded from the viewpoint of the business. If there is transaction concerning both the business and its owner, then it is recorded in the accounting records of the business. When the owner introduces capital into the business, it is credited to the capital account. To show the funds coming from the owner, the capital account shows a credit balance representing the amount owed by the business to the owner. When the owner makes drawings for the business, a debit entry will be made in the drawings account to show the value going to the owner, which reduces the amount owed by the business to the owner. Consistency. There are some areas of accounting where choice of method is available. For example, there are several different ways to calculate the depreciation of non-current assets. Where a choice of method is available, the one with the most realistic outcome should be selected. Once a method has been selected, the method must be used consistently from one accounting period to the next. This is known as the consistency principle. If this is not done, comparison of the financial results from one year to another is impossible and the profit of a particular year can be distorted. There may be a good reason why it is necessary to change the method of valuation in such a situation. The change may be made, but the effects of this should be noted in the financial statements. Duality. The principle of duality is also referred to as the dual aspect principle. Every transaction has two aspects, a giving and a receiving. The term double entry is used to describe how these two aspects of a transaction are recorded in the accounting records. Going concern. The accounting record of a business are always maintained on the basis of assumed continuity. This means that it is assumed that the business will continue to operate for an indefinite period of time and that there is no intention to close down the business or reduce the size of the business by any significant amount. This is the going concern principle. This continuity means that the non-current assets shown in a statement of financial position will appear at their book value, which is the original cost less depreciation. An inventory will appear at the lower of cost or net reserve value. If it is expected that the business will cease to operate in the near future, the asset value in the statement of financial position will be registered. Assets will be shown at their expected sales value, which are more meaningful than their book value in this situation. Historic cost. The historic cost principle requires that all assets and expenses are initially recorded in the ledger accounts at their actual cost. It is linked to the money measurement principle. Cost is a known fact and can be verified. Applying this principle makes it difficult to make comparisons about transactions occurring at different times because of the effect of inflation. Sometimes it is necessary to adopt more prudential approach to ensure that the non-current assets are shown at more realistic, so the cost price is reduced by depreciation. Matching. The matching principle is also referred to as the accruals principle. This is an extension of the realization principle to include both income and expenses. The revenue of accounting period is matched against the cost of the same period. The timing of actual receipts and payments is ignored. The figures shown in an income statement must relate to the period of the time covered by the statement, whether or not any money has changed hands. This means that a more meaningful comparison can be made of the profits, sales, expenses, and so on from year to year. Materiality. The materiality principle applies to items of very low value, items which are not material, which are not worth recording as separate items. Other principles can be ignored if the time and cost involved in recording such low value items outweigh any benefit to be gained from the strict application of these principles. For example, a pocket calculator purchased for office use is strictly a non-current asset, part of its value being lost each year through normal usage. The cost of calculating and recording this each year would amount to be more than the cost of the asset. Instead of the calculator being recorded as non-current asset, it will be recorded as an off-use expense in the year of purchase. What is material for one business may not be so for another business. A laptop computer may be regarded as a material for a large multinational business, but would be material for a small sole trader. A large business may decide that non-current assets costing less than 1,000 will be regarded as immaterial and be charged as expense. A small business may have a much lower value figure. This principle is also applied by entering small expenses in one account, known as general expenses and expenses, rather than having individual ledger accounts. For office expenses like light bulbs, flower displays, and so on. Materiality is also applied in relation to inventories of office supplies like envelopes. When the total cost of envelopes purchased during the year is treated as an expense, even though there are some left at the end of the year. Money measurement. The money measurement principle means that the only information which can be expressed in terms of money can be recorded in accounting records. Money is a recognized unit of measure and is a traditional way of valuing transactions. It does not rely on personal opinions and is factual. There are many aspects of a business which cannot be measured in terms of money and therefore do not appear in the accounting records. The moral of purpose, the effectiveness of good manager, the benefits of stock trading courses all play an important part in the success of the business, but they will not appear in the accounting records as the value cannot be expressed in monetary terms. In a similar way, laws of rival product or increased competition cannot be recorded in the accounting year as their effects cannot be measured in monetary terms. Prudence. The prudence principle is also known as the principle of conservatism. This principle ensures that the accounting records present a realistic picture of the position of the business. However, the excesses of prudence does not allow the deliberate understatement of assets or income, or the deliberate overstatement of liabilities or expenses. In short, prudence does not permit bias. Accountants should ensure that the profits and assets are not overstated and the liabilities are not understated. The phrase never anticipate a profit but watch for all probable losses is often used to describe the principle of prudence. Profit should only be recognized when it is reasonably certain that such a profit has been realized and all possible losses should be provided for. Prudence is a very important principle. If a situation arises where applying another accounting principle is contrary to the principle of prudence, then the principle of prudence is applied. For example, under the realization principle, profit is earned when goods actually change hands. But if the customer fails to pay after a reasonable time, the principle of prudence may be applied and the debt is written off. Realization. The realization principle emphasizes the importance of not recording a profit until it has been actually earned. This means that revenue is only recorded as being earned when the legal title to the goods or services passes from the seller to the buyer, who has then an obligation liability to pay for those goods. When an order is placed by a customer, no goods change hands and no profit is earned. Profit is regarded as being realized when the goods actually change hands. This is the same even if the goods are sold on credit and the customer does not pay for them immediately. International accounting standards. International accounting standards ensure that financial statements are prepared using the same rules and guidelines internationally. Knowledge of the individual accounting standards is relevant for ALOs. The objective of the standards are to ensure that the users of financial statements are protected and not misled. The quality of information contained in financial statements determines the usefulness of these statements. This quality of information can be measured in terms of four factors: comparability, relevance, reliability, and understandability. Comparability. The information contained in financial statements can be useful if it can be compared with similar information about the same business for another accounting period or at another point in time. It is also useful to be able to compare the information with similar information about other business. In order to make comparisons, it is necessary to be aware of any different policies used in preparation of information statements. Any changes in these policies and the effects of such changes, it is important to be able to identify similarities and differences between the information in the financial statement and the information relating to other accounting periods or other businesses. Relevance. Financial statements provide information about a business financial performance and position. This can be used as the basis for financial decisions. It is important that the information is provided in time for these decisions to be made. Information not available when required is of little use. It is also important that the information is relevant to users of financial statements. This means that it can be used to confirm or correct prior expectations about past events and also to help forming, revising, or confirming expectations about the future. Reliability. Information provided in financial statements can be reliable if it is capable of being depended upon by users of being a true representation of underlying transactions and events which it is representing. Capable of being independently verified, free from bias, free from significant errors, prepared with suitable caution being applied to any judgments and estimates which are necessary. Understandability. It is important that financial statements can be understood by the users of these statements. This depends partly on the clarity of the information provided. It also depends on the abilities of the users of financial statements. It is normally assumed that users of financial statements have reasonable knowledge of business and economic activities and accounting, and that they will be reasonably diligent when studying the financial statements. However, information should not be omitted from financial statements because it is decided that it is too difficult for users to understand. Capital expenditure. Capital expenditure is money spent by users on purchasing non-current assets and including extending non-current assets. This includes all the legal costs incurred in the purchase of non-current assets, cost of carriage for the purchase of non-current assets, and cost of expanding non-current assets. These costs will appear as non-current assets in the statement of financial position of the business. They should not be charged as expense in the year of purchase as they benefit the business for several years. The value of non-current assets often decreases because of depreciation. This cost will be managed against the annual revenue which the non-current assets help the business to earn. Revenue expenditure is money spent on running a business on day-to-day basis. This includes the administration expenses, the selling expenses, the financial expenses, and the cost of maintaining and running the non-current assets. It also includes the cost of goods purchased for the purpose of resale. These costs will appear in the income statement. They are matched against the revenue of the period. If these two types of expenditures are treated incorrectly, the profit for the year will be inaccurate and the statement of financial position with still balancing will also be incorrect. For example, if repairs to a machine were treated as an improvement to that machine, the expenses in the income statement will be understated. So the profit for the year will be overstated. In the statement of financial position, the non-current assets will be overstated and the capital also will be overstated because of the incorrect profit for the year. Capital receipt. The capital receipt occurs when money is received from normal trading activities. This includes the receipt of capital from the owner, the receipt of loans and proceeds of sale of the non-current asset. Capital expenditure is money spent on purchasing, including and extending non-current assets. Revenue expenditure is money spent on running a business on day-to-day basis. The capital receipt is money received by business from a source other than the normal trading activities. A capital receipt should not be entered in the income statement. If, however, a profit or loss is made on the sale of non-current asset, then it will be included in the income statement for the year in which the asset was sold. Revenue receipts. A revenue receipt is money received by business from normal trading activities. This includes revenue from the sale of goods, fees from clients, and other income, such as rent receipt, commission receipt, discount receipt, and so on. Because these arise from the normal trading activities, they are entered in the income statement. Inventory valuation. Inventory valuation is necessary to business to value its inventory at the end of each financial year. Inventory is always valued at the cost of net residual value. This is the application of principle of prudence. Overrunning the inventory causes both the profit and assets to be overrun. The cost of inventory is actual purchase price plus any additional costs such as carriage amounts incurred in bringing the inventory to its present position and condition. The net realizable value is the estimated receipt from sale of the inventory, less any cost of completing the goods or cost of selling the goods. Usually, the cost of inventory is lower than the net realizable value. It may happen that the goods are damaged or there is no demand for this type of goods because of change in taste of fashion. In this situation, the net realizable value will be more than cost.